Hi everyone. In this little video I want to go over exercise 1020 and 1021. Before I do that, I just want to give you some background information regarding this chapter. It's issuing what we call corporate bonds. So most people know bonds because they might have had a U.S. savings bond for their communion, graduation, confirmation, bar mitzvah. Maybe an aunt or somebody gave you a U.S. savings bond. But what a U.S. savings bond is a piece of paper or a contract between the person buying it, like your aunt for you, and the United States government. And typically they're buying it at half what we call face. So if it's a $50 bond, they're really paying $25. And then if they give it to you, you have to hold on to it till what we call maturity. And at that point, you could cash it in and get the $50. Corporate bonds are kind of along the same lines, but a little bit different. The relationship is between the person purchasing the bond and a company. All right. So again, the reason why a company would be issuing bonds is they're probably looking at borrowing large sums of money to maybe expand their business, and for cost reasons, they'd rather borrow directly from a person versus going through a bank. All right, it's more favorable, and it typically lowers cost. So anyway, so that's kind of what we're talking about. The issues though that come up with bonds or corporate bonds is it's a long process. The approval process is very long. We're talking about public companies. So if it's like a public hospital, or even if it's a nonprofit hospital, there's approval processes through what we call the board of trustees or the board of directors, accounting firms, their external auditors, their lawyers, and that process could take months, if not years, to get all these approvals in place to borrow the money. So it's a long process, and in the time frame where they actually what we call issue the bonds, the environment, the economic environment, or the environment or the economics of the company or hospital, whoever's borrowing the money, could have changed. They're still going to want the money, but the interest rates could change. So what happens is you get in this situation of offering a bond at what we call a discount, where you're kind of almost trying to just get rid of it. Nobody wants to buy it. It's hard to sell, so you discount it. Just like in a retail business where people go to the clearance rack and get something cheaper. So that's what we call a discounted bond. Sometimes the reverse happens. The company's doing really, really well. The interest rate is very attractable to investors, so it drives up the demand. So then it becomes a premium. It's kind of like if you have concert tickets and everybody wants to go and you can't make it, and you sell it online, and somebody bids up the price. So there are the two situations we're looking at. This first one I'm going to go through is what we call a bond discount. How I know it's a discount is this number over here, because it's less than 100, tells me it's a discount. So this company wants to borrow $1 million. They're going to borrow it over a 10-year period. That's the life of what we call the bond. The interest rate, the stated rate of interest, is 7%, and it's sold at 99. Because that number's under 100, it tells me it's a discount. They want us to do what we call straight line amortization of the bond discount. So that could be a little tricky, but I'm going to explain that. So I want to do A and B. And A is the issuing of the bond. Keep in mind what this 99 is telling me is I'm not getting the true 100% or 2 million. I'm going to slash the price. So the first thing you want to do with this problem is take 99, divide it by 100, and what that's going to come out is 0.99. All right. Why I'm telling you that is that's what's going on here. Or if you got a percentage button on your calculator, 99% of 2 million gives me this $1,980,000. So what we're receiving for cash for this bond is not the 2 million. We're discounting and we're getting less. So we're going to debit cash for the amount we're getting, which is going to be less. It's 99% of the 2 million. The face amount of the bond, or bonds payable, which is a liability, is going to be credited for 2 million. Because this is 1,980,000 and this is 2 million, we're going to use this other account called discount on bonds payable, and we're going to put the 20,000 in there. That number is just simply the difference between the 2 million and $1,980,000. So that's what we call issuing the bond. Again, because we sold it for less than the face value, we have this discount on bonds payable now. Why that becomes a little challenging is when we do this year-end journal entry for interest, that's got to be considered. All right, so I'm going to jump down here in B. This is the payment of the interest. One of the first things you're going to want to do is calculate out what cash is going to go down by. So cash is going to be paid out because every year we're going to pay them some interest. The 2 million was the face amount of the interest given. This 7% was the stated rate of interest. So 2 million times 7% means we're going to pay these bond holders, the people that bought the bond, $140,000 in interest at the end of the year. This is the beginning year, this is the end of the year. Because we discounted it, we didn't get the full amount, we shortchanged ourselves $20,000. We now have to allocate that $20,000 over the life of the bond, which is 10 years. So here, this next account here, this is the discount on bonds payable. That's the same as this account. We're going to reduce that, and how we're going to reduce that is we're going to take the 20,000, that was the discount, divided by 10. The 10 is the 10 years. Now we're going to amortize $2,000. So this 2,000 represents amortization of the 20,000 discount. When you add the 140,000 credit plus the 2,000 credit to discount on bonds payable together, you then get this debit to interest expense of 142. So in a second journal entry, you cannot calculate this number first. You're always going to debit interest expense, but you have to calculate these two numbers, the 140,000 and the 2,000 first, and add them together to get that number. That was issuing a bond at a discount and amortization at the year end when we're paying the interest of the discount. The second problem that I want to go over, BE 1021, is not a discount. So this is Harvard Inc. issues $4 million 5-year bond. So this is only 5 year. The one before it was 10. Stated rate of interest. The interest is going to be paid is 8%. What the 102 tells me, because it's above 100, it tells me it was issued at a premium. All right. Again, they want us to do the issuing of the bond. That's January 1st. And then they want us to record the amortization of the premium at the year end. Again, if you don't have a percentage button on your calculator, first thing you want to do is take that 102 and divide it by 100. So it's always going to be divided by 100. What that does is it makes it 1.02. The other one was a 99 bond, and so we also divided by 100 and it came out to 99%. This one, we're going to take the 102 divided by 100 and it comes out to 1.02. So that's, again, how they're getting this amount. They're taking the 4 million, timesing it by 1.02. Or again, if you had a percentage button on your calculator, 102% times 4 million is going to give you $4,080,000. So in this one, we're receiving in more money, and we're only going to pay out the 4 million. So notice in this one, now we got premium on bonds payable of 80,000. That's the reason for that is because we collected more money up front, 80,000 more. So now we credit this account premium bonds payable. At year end, we got to amortize this. The way we're going to amortize it is we're going to take the 80,000 divided by 5. Why 5? Because it's 5 years, and we come up with 16,000. The interest payable, because they're not paying it on this date, they're paying it January 1st. I'm going to credit interest payable for 320,000. It's going to be the 4 million. That's the value of the bond times 8% gives me 320,000. How I got this interest expense of 304 is I have to take the 320, that's the interest I'm paying out, and minus the amortization of the premium, which is 16,000, and that's where the 304 comes from. So again, the premium is really the complete opposite of the discount. I'll zoom this out a little bit so I could show you both right next to each other. The first one we did, again, was what we called a discount. With the discount, when you issue it, you're going to have discounts on bonds payable debited. When you have a premium situation, like you do down here, you're going to have a cash account on bonds payable also, just like you did up there, but there's going to be a credit to premium on bonds payable because you got more money in. This one we got less. This one we got more. When we record the interest expense, if it's a discount, again, we can't figure out the interest expense first. We have to figure out these two. So the cash that's going out is going to be 140,000. That's simply the face amount of the bond times the interest rate. The amortization of the discount is, again, just simply the 20 grand divided by the life of the bond, 10 years. The credit, these two add up to that. On the premium, we calculate the premium, amortization of the premium. Because it went on with a credit, we're going to remove it with a debit. We're going to take that 80,000 divided by the life of the bond, which is 5 years. That's how we got this number. This 320 is, again, simply the face value of the bond times the stated rate of interest, which is 320. But in this case, to get the interest expense, we're going to subtract these two. All right, it's a little bit tricky. Hopefully this helps a little bit, and I'll talk to you soon.